Good morning and welcome to Time Price Analysis. This video is being recorded at 10 a.m. in the morning GMT on Tuesday, February the 6th. And after the falls we've seen in world stock markets on Friday and Monday, I thought it'd be opportune to take a look at the major US markets this morning, starting with our long-term chart of the S&P 500 index. So this is a weekly chart, and if we go all the way back to March 2009, which was the last significant swing low that we saw, and we are labeling that as a cycle degree wave 4 in Elliott wave terms. We use Elliott wave theory mixed with Fibonacci projections and Hurst cycles to analyze the markets on behalf of our subscribers at Time Price Analysis. So taking this chart, and we count 1, 2, 3, 4, 5 waves up for a primary degree wave 1 into the April 2010 high, the wave 2 back. We then take the length of this wave 1 and project it up off the wave 2 using logarithmic scale Fibonacci numbers. So at the next Elliott wave fractal degree down, which is intermediate degree, we can count a 1, 2, 3 into the high seen in May 2015 with an A, B, C back for the 4. That high hit a 123.6 extension for the wave 3 of a much bigger wave 3. The wave 4 then held the 1.0 extension. So that's textbook stuff from a Fibonacci projection and Elliott wave perspective. So since then, we've had a low into February 2016, and then a very, very strong move to the upside, culminating in a high last week, and then this sell-off for a couple of days. So let's start to put that into some kind of perspective. What I want to do now is come down to a daily chart. So this is on a daily time frame, and this is the wave 4 at intermediate degree of trend seen back in February 2016. And again, 5 waves up for the wave 1 at the next Elliott wave degree of trend down, or next fractal down, which is minor degree. There's the 1, there's the 2. And again, length of the 1 projected off the 2. So we can see then the orange labeling is for the 5 waves that make up this blue wave 3. And we had a 1, 2, 3 into the early August 2017 high, and an A, B, C for a small back. And this, therefore, that we've been in since the mid-August 2017 low was a wave 5 that then accelerated to the upside towards the end of last year. Now, on our charts, we've had a target at 2903 SPX. Once we got through 2837, which was the ideal target, the 223.6 fib, which if you look at the S&P 500 and the ES Mini, which is the futures contract on the S&P 500, the wave 3s have been hitting a 223.6 extension of the wave length of the wave 1 projected up off the 2 quite often. So we exceeded that, and we were looking up towards 2903. And the market has topped shy of that at 2872.94 last week. So from that high, we have then been expecting a wave 4 pullback at minor degree of trend. And we would expect that wave 4 to come in between the 38.2 to 23.6% retrace, Fibonacci retrace fibs of the length of the wave 3 projected off the bottom of the 2. So somewhere between SPX 2408 and 2576. We can run another set of numbers, which are these blue Fibonacci extensions. We would expect that it would come no lower than the 1.0 extension off the low, which is 2333, and could remain as high as 2479. The other Elliott wave guideline is that we'd expect this wave 4 to come down into the region of the wave 4 of 1 lesser degree. Well, that wave 4 came in here at 2423 SPX. So that gives us our target box and range of expectation for the wave 4. Now, this chart is of the S&P cash market. So overnight in the futures, we've exceeded this low by some 80 odd points and then bounced back. So if we now come over and look at the ES mini daily chart, this is the equivalent of the S&P cash chart I was just showing you. And again, off the February 2016 low, there's the 1, there's the 2, running the fibs again, 3, 4, 5 up to here. And you can see in a similar way, it came just above the 223.6 Fibonacci extension, didn't quite get up to the 238.2. Now, this moved down to 25.93 or so, represents all of the move down in the futures market, which includes the overnight action. And the question is that the bottom of the initial A wave of 4? So corrective waves in Elliott wave come in threes. You get an A, B, C. And once we have the bottom of this A wave in, we would then expect a retrace of between 61.8 and 76.4% of the entire move down. So if this is the bottom of the A wave, we'd now expect to see a move back up to ES 2767 to 2810 before we resume the downside. So let's investigate that a little bit further. This is a very basic hourly chart. This point at 0 here is the high we saw last week. And I think what we have here is most likely an A, B, C for a completed A wave. And that's my primary expectation at this point. So if I take the length of this A wave and project it off this small B wave, you can see that the overnight low hit the 161.8 extension pretty much to the penny at 2529.24. And we've seen a very, very strong move to the upside from there, which I suspect is the initial A wave up of this B. Taking this further, if we then come up to the 764 retrace here at 27.95 and then take the length of this entire move down off the top and project it off that level, it gives us a target range down here at the 1.0 to 138.2 extension. So the most common relationship between the length of an A wave and the C wave is either parity at 1.0 or the 138.2. So we would expect, therefore, a range of 23.14 to 24.46/47 in the ES to complete the wave 4 in its entirety before we then resume the bull market trend up to the completion of the larger degree wave 3, which we're expecting to see later this year, perhaps into early next year, at somewhere around SPX 3200 level. Now, there is an alternative here in that off the low, we could count this as a 1, 2, run the same Fibonacci projections, and the standard expectation for a wave 3 is the 1618 extension. So the length of the 1 projected off the 2, and obviously we've hit that. We would then expect the wave 4 to remain absolutely below the 618 extension, but usually below the 764. So those come in at SPX 2652 to 2674. So if we remain below those levels, then we can still come down again in the next day or two to somewhere around 2473 or perhaps even lower. This can extend to a lower level before we then see the B wave. And if we see that, I would expect to see quite a deep B wave and then down to not that much lower to give us a wave 4 flat correction in the US indices. So if I then go back to the S&P 500 daily chart, once we've completed this 3 and this 4, once we've completed this wave 4, we're then expecting this move up to one of these levels up here. If I go back to my weekly chart, the ideal would be the 2.0 extension here, which is the length of the primary degree wave 1 projected up off the low of the primary degree wave 2, and that comes in at SPX 3383. There is a chance that we get a small 5 and we only see SPX 2933, but I think that's unlikely. But again, we can deal with that once we've got the waves 1 and 2 of this wave 5 in place after a confirmed low for this 4. So although it feels like the whole world fell off a cliff yesterday, in relative terms, it's a healthy and overdue correction. And it's just the initial part of that correction that we're now seeing in the US markets. Just to finish off, then let's have a quick look at the NASDAQ, the technology index in the US. And this had a more complex wave 4 at intermediate degree, when the low didn't come in until June 2016 here. But in a similar manner to the S&P 500, we then have a 1, 2, and we can count 1, 2, 3, 4, and we were in this 5th up with an accelerated, extended final part of that. The ideal target we had for that top in the NDX was at 7066, and we topped at 7036. So we'd now expect to see the NDX come down here to 6214 to 5761, and I think the 5761 to 5799 area is more likely, because again, using the Elliott wave guidelines, the wave 4 of 1 lesser degree resides here at 58 to 28. So again, A, B, C. The A will obviously come a little lower than this chart showing, because this is the cash index, which doesn't benefit from the overnight futures action. And I would expect volatility early on in the markets today after the open, while the cash markets come down to make whatever final low for the A wave they're going to make before we come back up, or for the 3 of an impulse down for the A, and we get a 4-5 to lower before we resume the upside. So for people trading these markets at the moment, treacherous stuff in the futures day by day, and just trade carefully and use far smaller stakes for your trading would be my suggestion. But this is not the bigger correction that we're expecting after we see this wave 3 complete later this year to early next year, when we're looking at a much larger correction in the US indices. And again, going back to our S&P 500 chart, we're looking for a move down to somewhere between 1850 and 2132 in the S&P 500, with the possibility it stays as high as 2329, but that's going to be from up at 3383 or so, and that is a more significant correction. But again, it would simply be a correction in an ongoing bull market.